Portfolio management philosophy is an important thing to have when managing retirement assets. It's critical to understand your financial advisor's investment philosophy, how they choose, monitor, and replace portfolio managers on your behalf. Let's take a look at the three types of portfolio management philosophies. Hi there, I'm David Dennis from Dennis Financial. This channel is all about common sense financial advice for Canadians without taking up a ton of your time. At Dennis Financial, we believe in advice, education, and organization for every one of our clients. If that's something that you're interested in, please like, subscribe, and leave a comment below. At Dennis Financial, we want to give you the confidence to stick to a well-defined portfolio investment philosophy. A quality portfolio management philosophy should include best-in-class thinking, which basically means an objective approach to your money management, which means access to top investment professionals from around the globe. The portfolio philosophy should be disciplined, which means that there is a systematic approach which can effectively diversify your portfolio's risk, geography, and investment sector. Lastly, a portfolio philosophy should also be objective, which means there's ongoing oversight of the portfolio managers to be able to take advantage of opportunities and manage your risk strategy. Let's review the first portfolio philosophy, and that's security selection. This type of investor often uses the term best, like best fund manager, or best fund company, when they're describing their portfolio philosophy. It's easy to identify this type of investor because they often use terms like top quartile, 5-star fund, or superstar fund manager. If an advisor is trying to find the best portfolio manager or the best 5-star fund, they're often using some level of software to do their research. They're looking at the past to determine what might happen in the future. Most people will call this portfolio management philosophy like driving a car while using the rearview mirror. You don't necessarily see what's in front of you because you're often looking in the past to determine your path. A study completed by the Wall Street Journal in 2017 shows the performance of 5-star managers versus their peers lower than them. Over the 10-year period, you can see that all of the portfolio managers, regardless of their star performance, all tend to converge. Some of the interesting statistics here are that 12% of the funds awarded the coveted 5-star review in the first year only received a 5-star review in the following 10. Also, 10% of those 5-star managers performed so poorly that they received a 1-star rating by the 10th year. So what does this tell us? Well, statistically it says that past performance does not necessarily mean future performance is guaranteed. To use a baseball analogy, it's often prudent to pick a portfolio manager who is going to get you on base, regardless of how many home runs they hit. The next type of portfolio philosophy is called market timing, and this is the most common of the portfolio philosophies that most investors use. This is the emotional investment philosophy. These types of investors are often changing their portfolio, the mixture or the funds within that portfolio, based on the news, what portfolio managers are saying, or on a gut feeling. This type of investor will often use terms like Canada's on sale or oil is out of favor. This portfolio philosophy is like trying to catch a knife. It's incredibly difficult to catch a knife if I were to drop it. So for example, if I held a knife out, and you held your hand out, and I drop that knife, it might be difficult to catch it every single time. It may drop on the floor, you may cut yourself, or you may catch it perfectly. But it is quite difficult to do. Most gains on the equity or stock market happen in very short, unpredictable time intervals. We believe to maximize your long-term investment performance, you have to ride out all types of markets up or down. Putnam Investments in 2020 did a study. They looked at the last 15 years. If you had invested $10,000 in the S&P 500 and rode out all of the ups and downs of that market, you would have returned 9.88%, which would mean that your $10,000 would grow to $41,100. Now, if you just happened to miss the 10 best trading days, so if you got out of the market because it was going down, and you missed the 10 best trading days, your return would drop from 9.8% to 4.3%, and your $10,000 would only grow to $18,000. Now let's say you missed the 30 best trading days. So you pulled out of the market during turmoil and you waited until it recovered before you put your money back into the equity markets. That means you would have a negative return of 1.88%, and your $10,000 would actually decline in value by $7,500. What this tells us is it's important to ride out the markets, to not miss the most important trading days, which are often short and quite volatile. The last type of portfolio investment philosophy is asset allocation, and that's the one that we use here at Dennis Financial. An asset allocation strategy is often a risk-managed portfolio philosophy. Some people will describe it as pension-like approach, and this is very much the same methodology that the Canadian pension plan follows, as well as most provincial pension plans. So what does an asset allocation portfolio philosophy mean? Well, that means that you invest in a single portfolio, which is designed to meet your investment goals based around your investor level risk. Rather than looking for an absolute total or best return, you're looking for the right amount of return based on your risk profile. An asset allocation portfolio philosophy often means that there is lower volatility, there's less concentration in your portfolio and more diversity. That means there's more balance in your holdings. There's often greater geographic and sector diversification, and it includes multiple portfolio managers rather than one manager making all of the decisions. As you move up the asset allocation spectrum, the amount of equity or stock added into your portfolio increases. Often, more equity means more volatility or more movement in your portfolio. Completing a client profiler often aids this type of investor in choosing their portfolios. It gauges your level of risk and understanding of portfolio movements. Then, you would choose a portfolio around that to ensure that your portfolio meets your portfolio objectives. Hopefully now, you will have a better understanding of the three types of portfolio management philosophies and how to identify them. Remember, it's always important to understand your advisor's portfolio investment philosophy and how they pick their portfolios, how they monitor their managers, and how they replace those managers if they need to. I've attached our free guide, What to Expect from Your Advisor and Why, in the comments below. Thank you very much for watching our video today and have a great day.